Hey guys, welcome to Smart Finance channel. Before I discuss this video content, I would like to ask you to subscribe my channel so that you will receive my new videos coming out every week, and also remember to like and share my videos to your friends and families. Alright guys, let's get started. In this video, I will guide you how to handle your money after getting laid off. COVID-19 has affected the capacity of Americans to prioritize their financial commitments. Everything from paying the mortgage to paying the bills after losing a job is covered in this video. Since the beginning of the coronavirus epidemic in March, the economic downturn has affected the capacity of millions of Americans to meet their financial responsibilities. According to data published by the Economic Policy Institute, 20 million employees would be fired off or forced to take unpaid leave by July 2020. It is crucial to have a strategy for paying your expenses following a job loss, since the probability of getting laid off is a reality for many. Here are some costs you should be able to handle in the case of a layoff. Housing costs, food and essential items, insurance, utilities, credit cards, auto loans, and student loans. Housing costs. After suffering a sudden loss of employment, maintaining a roof over your head is likely your first priority. There are services available if you are unable to make your mortgage or rent payment, despite the fact that it might be difficult to work things out. As quickly as possible, contact your loan servicer if you are a homeowner. After a loss of income, several banks have permitted mortgage borrowers to defer payment for a certain time, or create other payment arrangements. If your mortgage is federally supported, you may potentially qualify for forbearance under the terms of the Coronavirus Aid, Relief, and Economic Security CARES Act. Tenants could talk to their landlords or management companies to see if they may accept a partial rent payment or provide a temporary rent reduction. With a long rental history and consistent payments, they may be prepared to work with you. In addition, the CARES Act and several states have placed a moratorium on evictions during the epidemic, which prohibits landlords from charging late fees, fines, or serving eviction notices if you cannot pay your rent. However, this moratorium only applies to houses with federally backed mortgages. Therefore, it is prudent to determine whether your scenario qualifies you. Don't Get Kicked Out is a useful website that explains your state's existing eviction rules and helps you get legal assistance so you may remain in your home. Food and essential items. In addition to shelter, food is another need during periods of unemployment. Depending on the amount of unemployment or other income you receive, you may be eligible for Supplemental Nutrition Assistance Program SNAP payments. Visit the SNAP eligibility website for additional information on qualifying criteria. Additionally, 211 can assist you locate local food banks and pantries for urgent needs. Insurance. Your first action after a layoff should be to contact your former employer to see if you will continue to get health insurance coverage, and, if so, for how long. COBRA, the Affordable Care Act ACA, and Medicaid, provided you satisfy income criteria, are additional possibilities for coverage after a job loss. Due to recent stay-at-home orders, several insurers have offered to credit monthly payments for auto insurance. Check with your insurer to see whether this applies to you or to make payment arrangements in order to maintain coverage. Utilities. For emergency payment arrangements for utilities such as water, electricity, gas, mobile phone, and internet, check with each of your suppliers. Some states have enacted temporary regulations to avoid the disconnection of utilities for delinquent payments. However, you should still contact out and explain your circumstance on your own before this moment. credit cards, auto loans, and student loans. Federal student loan debtors are not obligated to make payments until September 30th, 2020, according to the CARES Act. If you have private student loans, you should contact your lender directly, since some also provide temporary forbearance alternatives. If you are unable to make your next monthly payments on credit cards and vehicle loans, chat with your bank about alternative arrangements. Several banks and credit unions let clients with financial problems to delay payments or make partial payments. Payment options following a job loss. Emergency savings. Credit cards. Retirement savings. Additional sources. Emergency savings. In the case of a job loss, it is advisable to have at least 3 to 6 months of savings. Nevertheless, saving that much may take years, and you may be a long way from reaching that amount. If you are lucky enough to have emergency reserves, you should spend these funds before turning to credit cards or retirement funds. Not to panic if you lack a fully funded emergency cushion. When one is cash-strapped, every little bit helps. $100 or $200 is plenty to fill up your petrol tank and buy food for a few weeks. And if you can keep even 1 month ahead on your payments, it might offer you with much-needed respite as you look for a new career. Credit cards. After a job loss, it's important to minimize the amount of debt you incur. But in an emergency, it may be essential to utilize credit cards to keep afloat. As you adapt to a loss of income, you will gain some peace of mind if you can cover the necessities. If you lack cash and need food, petrol, or other emergency necessities, utilize your credit card as you see appropriate. The trick is to be really explicit on what constitutes a need. Consider credit cards as a short-term solution, rather than an unending supply of cash while using them. Also, prepare to pay off any outstanding balances after you regain your financial footing. Retirement savings. It's not ideal, but if you don't have enough cash or credit, you may have to take money from your retirement account to pay your payments. The CARES Act increased the borrowing limit for 401k loans from $50,000 to $100,000, which may enable some borrowers to defer payments. During this period, withdrawals from retirement accounts will not incur a tax penalty. In addition, you may take funds directly from your 401k, and the 10% early withdrawal penalty will be eliminated for withdrawals up to $100,000. Additional sources. It may be difficult to maintain your financial stability at this period, but remember that assistance is available. Check with your local governmental agencies for assistance to help with utilities bills and other financial needs. Well, guys, my video has come to an end, and I hope you enjoyed it. Thank you for watching my video, and remember to like, comment, share and subscribe our channel, so that our channel can grow and bring everyone new videos with new things to learn. Bye bye for now, and see you in my next videos.